we're seeing both the Nifty mid cap and small cap indices trade lower. First, let's talk IT though. Let's set this context straight. Sandip Agarwal, fund manager, Sowilo Investment Managers, joining us this afternoon to give us that perspective. Sandip, I want to start off by understanding from you the business itself and how you view it. Do you believe that AI can disrupt the IT, the core business of some of these large IT players? It's probably a yes or a no, but if there's a gray area, give us a sense.
Hi, good afternoon, and thanks for having me on the show.
Good afternoon.
So, the business model is always same, and it is very, very clear that we recruit people from the market, we train them, we skill them, and we deploy it for the client. The model could be fixed price project or time and material, and we were going through this business model for more than 3 decades. Good part is that till before AI came into picture, every time whenever disruption used to happen in technology, it used to enable 2 things. One, improve the experience and increase efficiency. So hardware cost used to be stable or kept on going down, while software services expense and software expenses used to go up. Now, and because of that, every time, whenever IT stocks fell, they used to fail only for 3-4 quarters, and then they used to recover much strongly, because whatever new technology disruption happens, the business, you have to retrain people, and basically again you are the only one whom the client will take for new projects. Unfortunately, with AI coming in, what has happened is that for the first time in last 4 decades in technology, the efforts itself has got hit very badly. So basically what AI does is that it cuts down your effort by 20 to 30%. And because of that, this time it was different, and we have been maintaining this for last 14 to 16 months in every interaction, that please don't simply say that, we have seen many disruptions and every time we have come strong and all that. Every disruption you have seen in the past, that has actually resulted in more and more work. This is the first disruption where work is going down. So whatever our strength was, that to recruit people at scale, train them at scale, and deploy that at scale, that whole moat has been challenged. Now, the bigger problem for in my view is that, only our contracts for IT companies are broadly 4 to 5 years, 6 years based. So basically every year 15-20% will come for renewal, and whenever and as a vendor, I will not go and preempt the renewal. So I will wait for it to come for renewal, because I know if I go, then there will be 20-25% cut in the value of the project. So we wait. So every year 20% will come, and it will be negotiated for 20% lower. So basically every year you will have 4-5% negative impact on growth. So basically if you do 10% growth also, your net growth will be 5%. My problem is with this slow death which is going to happen for next 3-4 years, where every year growth will be mid-single digit, and for that you are paying 18-20 multiple, which is 3 to 4 time PEG ratio for an industry which has 5% growth. So I have that as a serious concern, and I believe that either the price reset has to happen very aggressively, or growth has to pick up.
I get your point, Sandip. I totally get it, and in fact you're one of the few people who have called it out as well, all of this. But talk to us about how sticky the business of some of these IT service companies are, because what some analysts in the market seem to be suggesting is that the stickiness with the client and the stickiness with the fact that there are settled softwares on which a lot of the data which comes through and which gets interpreted at a company level is built, and a lot of these are built by some of our large IT companies. It's very unlikely that some of the new disruptor companies can come in and integrate their it's not a plug and play, right? They're not going to be able to integrate their AI models into the current architecture, if I can call it that. So what's your take on that?
No, absolutely right. So let me be very clear that I am not negative at all, or I don't have any doubt on the business model. We are having a robust business model. No one can compete with us on that, and I don't see a 1% risk on the business model. I have only challenged that we are entering a low growth phase for next 2-3 years, and because of that the valuations are not right at this juncture. I have zero doubt that anyone else can do this work. No one can do, and I think forget stickiness. We are the software factory in the world. That position no one can change. Revenue of none of the IT companies, any major IT company will decline. I am reasonably sure of that. What will happen is that growth will fall to mid-single digit. Now for mid-single digit growth, I as a fund manager would not be willing to give a multiple of 20 times or 18 times. That is the only disconnect. I reiterate that, no one can touch our business models. They are very strong business model. There is no alternative to it at this price. So we are very safe from that perspective. I don't see any problem of, any challenge on the economy because of this and all that. There will be low growth in employee addition for next 2-3 years. There will be low growth in revenue. But beyond that, I don't see that revenue will decline or all those things will happen. That is wrong way of interpreting the current challenge.
So help us put this better into perspective. You're saying you're expecting a low single-digit decline. Talk to us about across the board, large caps and mid caps put together. What could be the impact on revenue, margins, EPS? Talk to us about what happens.
So I am saying that low single-digit decline because of AI, and then you obviously will get new business. So net, the large companies, I think, large cap companies will grow at 5-6% for next 2 years, and the mid cap companies will grow at 10 to 12%, and small cap company also in that range. Now for 5-6% net growth, and I don't think any of this technology will lead to margin dilution at all. Margin will be maintained. It may little bit improve also because of the efficiency. So the EPS growth will be 1-2% higher. So for large cap, if the revenue growth will be 5-6%, the EPS growth could be 7-8%. For mid cap, the revenue growth will be 10-12%, the profit growth could be 13-14%. But for that growth and for a longer period of time, why should I give a 20 and 30 multiple? That is my question. So I have worries on the multiple which are being assigned. I don't have any worry on the business model at all.
And I think the market is hearing you, because no longer 20 times. We're trading at sub 20 times both on TCS and Infosys. Of course, I recall you saying that 10 times is broadly the multiple you would give between 10 and 15 now to some of the large IT companies. I recall that. I'll just reiterate because I know we have to let you go. So we'll let you go on that note. Thank you so much for coming in and speaking with us.
Thank you.
Okay. We also spoke